A fantastic approach to increase your wealth and safeguard your financial future is by investing your money. Investing may be done in a variety of ways, including mutual funds, real estate, and stocks and bonds. No matter which type of investing you choose, it's important to have a plan and to start investing as soon as you can. Here are 5 ways to start investing right now. Before starting, don't forget to like and subscribe to the Financial Tech channel for more future updates. Let's begin, then. Number 1. Open a brokerage account. A brokerage account is a great method to start investing and expanding your portfolio. An investment account that enables you to purchase and sell stocks, bonds, and other financial instruments is a brokerage account. It is managed by an online broker that offers resources and services to support decision-making and investment management. Finding an online broker that best suits your requirements and with whom you feel comfortable dealing is the first step in obtaining a brokerage account. You should consider the commissions a broker charges, the range of products they provide, their level of customer support, and the trading platforms they use before making your choice. Determine your investing style, whether it be cautious or more aggressive, since this will assist you decide which kind of account would serve your requirements the best. After choosing a broker, you will need to fill out additional documentation. Depending on the kind of account you're starting and how much money you want to put into it, different documents will be needed. Your name, address, phone number, social security number, agreement papers, and any other documentation the broker may need are all included in the paperwork. You must fund your account when the paperwork is finished. You may accomplish this by sending money straight to the broker or by moving money from an existing bank account. The broker could also let you fill your account using a credit or debit card. Number 2. Invest in mutual funds. Particularly if you are a novice investor, mutual funds are the best option to invest your money. A mutual fund is an investment vehicle that is professionally managed and collects money from several individuals to invest in stocks, bonds, and other assets. A fund manager who has expertise investing and choosing the best potential investments for the fund manages mutual funds. Because they invest in a broad range of stocks, bonds, and other assets, mutual funds are an excellent way to diversify your portfolio and lower your risk. Investors are drawn to mutual funds because of their high cost effectiveness. They provide a considerably more affordable approach to get exposure to a variety of assets than purchasing individual stocks or bonds. Additionally, mutual funds have high liquidity, making it simple to sell your shares at any moment. Mutual funds also provide a variety of fund types, including sector funds, growth funds, income funds, index funds, and more. This enables you to choose the best kind of fund to achieve your investing objectives. Finally, compared to many other assets, including savings accounts and money market accounts, mutual funds give a better return on your investment. They are thus a fantastic strategy to gradually increase your money. Number 3. Invest in exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are a kind of investment that follow an index, industry, or commodity in particular. They are among the most popular investments for both private investors and institutional investors. ETFs provide a cheap, liquid, and diversified alternative to invest in the stock market. The main advantage of ETFs is their affordable structure. ETFs often have lower expense ratios and trading fees than other types of investments. This is partly because ETFs are passively managed, which means that a portfolio manager does not actively manage them as a mutual fund would. Like stocks, ETFs also have a distinctive structure that enables investors to purchase and sell shares on a market. ETFs are now simpler to trade, giving investors additional options. ETFs are useful for diversification as well. Investors may expose themselves to a variety of assets and industry sectors by purchasing an ETF. This diversity may improve returns while lowering the portfolio's total risk. Since they may be bought and traded like stocks, ETFs also provide liquidity. Investors may swiftly enter and exit positions thanks to this. Number 4. Invest in stocks. One of the most common and effective methods to increase money is via stock investing. It may be a fantastic method to increase your income and create lasting wealth. While purchasing stocks might be a terrific method to increase your wealth, it's crucial to comprehend the hazards involved. There are certain crucial factors to take into account while investing in stocks. You need to decide what kind of stock you wish to buy. For instance, you could wish to put money into blue chip stocks, which are held by businesses with a proven track record of success. Additionally, you may want to think about investing in mutual funds or ETFs, which are stock basket-based ETFs. You should investigate the firms whose stocks you are contemplating in addition to determining what kinds of stocks to invest in. Look at the company's finances, have a look at recent headlines, and question friends or relatives who may have dealt with it before. You may invest in stocks with the best choice possible thanks to this study. When investing in stocks, having a clear approach is also crucial. You should determine your risk tolerance, the amount of money you are prepared to invest, the kinds of stocks you are interested in, and the length of time you want to keep them. This plan should be examined and modified as necessary. There are no assurances when it comes to stock investment. The stock market may be unpredictable, and if the value of your equities drops, you might lose money. However, investing in stocks may be a terrific method to enhance your wealth provided you are prepared to do your homework and have a well-defined plan. Number 5. Retirement accounts. A 401 and IRA. A 401 plan and an IRA are both retirement savings accounts, but the two accounts have specific characteristics that separate them. A 401 plan is an employer-sponsored retirement savings plan. Employees often deposit a percentage of their paycheck into the account before taxes are taken out, and the company also contributes to the plan via matching money, investment returns, and occasionally extra employer contributions. Contributions to a 401 plan are normally capped to $19,500 per year in 2021. Earnings inside the 401 are tax-deferred until withdrawals commence, often made in retirement, at which time they are taxable as regular income. An IRA, or individual retirement account, is a retirement savings account which enables account users to save and invest for retirement using their own cash. Generally, contributions to an IRA are restricted to $6,000 each year in 2021. Contributions may be tax-deductible, and profits inside the IRA accumulate without being taxed until withdrawn in retirement at regular income tax rates. In addition, one's IRA may be invested in equities, bonds, mutual funds, and more. This is it for today's video. What do you think of our video? Let us know in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.